Bismillahirrahmanirrahim. Subject is financial management. In today's topic is capital budgeting and estimation of cash flow. This is sixth online lecture. In today's lecture, we will discuss what is capital budgeting. We will also discuss capital budgeting process. Then what are investment project proposal, different kind or classification of investment project proposal. Decision making process on project proposal, how the proposal are have been go through the process of screening, and then how decisions are making in the organizations. Then estimating after tax incremental cash flow. Then we will discuss tax consideration and depreciation. Then depreciation and makers method, modified accelerated cost reduction schedule method. We will discuss that in this lecture. Now, what is capital budgeting? Capital budgeting is basically identifying a proposal, then evaluating any investment, then selecting any investment, but only those investment that provides a cash flow to the organization behind 1 year. So the process of identifying, analyzing, and selecting. Identifying, then analysis, then selection of any investment projects, but not short-term investment. It is basically not short terms, it is long-term investment. So whose return means cash flows that are generated by that investment are expected to extend beyond 1 year. We will not consider those projects in capital budgeting whose cash flows are whose life is less than 1 year. So what are the examples of capital budgeting? Capital budgeting, budgeting for purchasing a new machinery, because machinery provide a cash flow more than one accounting periods. Construction of new building have more than one accounting, have life of more than 1 year, so it provides a cash flow for more than 1 year. So these are only two examples of those investment that comes under capital budgeting process. What is capital budgeting process? Generate investment proposals consistent with the firm's strategic objectives. So investment proposal and firm strategic objective, these two things must be aligned. If pharmaceutical firms going to invest, let's suppose in mining, that it is not aligned with the strategic objective of the pharmaceutical firms. Similarly, if any of the mining company going to invest in a, let's suppose in a project for discovering vaccine for COVID-19, it is again its strategic objective of the mining companies. So only those investment products should be generated which are aligned with the strategic objective of the companies. Then when we generate an investment proposal which is in line with the firm's strategic objective, then we will estimate its incremental cash flow, incremental operating cash flow, not earning nothing else, only we will consider a cash flow of this investment projects. Now we will evaluate the project incremental cash flow. These are different evaluation technique which we will discuss in the coming lecture, such as IRR, such as NPV, such as payback period. These are different technique which we will discuss in coming lectures. Then select project based on value maximizing acceptance criterions. If we have, let's suppose, more than 10 project, then we will accept only those which maximizes wealth of shareholder. How wealth as value maximizing, how we will decide that this specific project is value maximizing project or value destroying project. Those who have positive NPV are considered as value maximizing projects. Then when we select the project, we will obviously conduct a post-completion audit. Post-audit for completed projects. So post-completion audit is very much necessary because we will this audit will highlight the weaknesses that have been observed in the audit, or any other issues will be highlighted in post completion audit of the project. So first of all, generate investment proposal that is aligned with the strategic objective of the firms. Then incremental cash flow will be estimated. Then we will evaluate the incremental cash flow. Then we will select those projects which are value maximizer, and then we will conduct a post completion project for these investment proposals. Classification of investment proposals. New product or expansion of existing product. For example, pharmaceutical firms, when decided to invest in developing a new medicines, then we will call that as a new product, or it may modify its existing product. It will be called expansion of existing products to the it will also be called investment project proposal. Similarly, if any companies enter into a new market with existing product, it is called it will also be investment proposals, project proposal. Second is, let's suppose, first example or classification is new product development or expansion of existing product. Then replacement of existing equipment or building, that is second classification. Maybe old equipment have been disposed in new, when new are purchased, it is also replacement of equipment. Even new equipment will also, a new construction of building is also one of the classification of investment project. Research and development is also investment project proposals. In research and development is basically research and development is conducted in order to develop a new product or any development patent right, or it is basically research and development is provide the basis for the sustenance of the company. Those companies who's continuously invest in research and development projects, they sustain for a longer life because they develop a new product, they provide new design to the existing product, just like high-tech companies continuously earning through research and development on their existing product or develop a new product. If any company, let's suppose, let me quote an example of Pfizer. Pfizer is claiming that they have developed vaccine for COVID-19. So, how this new research and development will help the Pfizer, because this new research and development project that have been result in a developing of COVID-19 vaccines, it will provide a long-term supports to the Pfizer. That is one of the pharmaceutical company. Exploration is related with the mining company. If the company go to new exploration of new reservoir of the oil, new reservation of the reservoir of the coal, or new reservoir of the any other minerals, it is also one of the investment project proposals. Other examples are, maybe these are related to the CSR. If any company want to buy a system of safety, or it want to buy any machineries or any extension to the new machineries that control pollutions, it will also comes under the investment project proposals. Screening proposal and decision making process. How we will screen the what type of screening is involved when proposal are developed or adopted. First of all, section head of any section will identify the project, or will identify any project that provide the companies that provide a benefit to the companies and result in maximizes the wealth of shareholder. First of all, the section head will identify the project. Then it will be discussed with the plant managers. Plant manager means there are many section head under the plant manager, in the supervision of the plant manager. So these section head will communicate their proposal to the plant manager. They will discuss it. If it is viable, then it will move further. Then vice president for the operation, this plant manager will discuss this idea or refine the idea, and then discuss it with the vice president of the operation of the company. Then when it is finally approved, then capital expenditure committee will decide whether to adopt the project, whether to accept the investment proposal or to reject it. When capital expenditure committee finally accept or agree with the idea, then president decided on the project. If the project is a huge that do not comes under the authority of the president, then then it will be discussed in the board level. Board of director will give final verdict or final decisions on the project. But these advancement to the next level depends on what? It depends on the cost and strategic importance. Two things are involved. One is cost, and second is strategic importance. If it involves a huge cost, but it is of strategic importance and crucial for the company to accept the investment proposal, then it will be moved further. So if it is a huge, if any investment proposal have a huge cost, but it is not that much importance to the strategic direction of the company, it will not be accepted. Estimating after tax incremental cash flow. Basic characteristic of relevant project flow. First, we will consider a cash flow. We will consider a cash flow, not accounting income that is calculated on accrual basis of accounting. Second is operating cash flow. We will only consider operating cash flow. not financing, not investing. The cash flow that have been generated by that specific project, we will consider its operating cash flow. Third is, we will also consider the taxes. When the company paid taxes, we will just consider for our decision making that after tax cash flow. How much this new project result in increase in the cash flow. So we will only consider incremental cash flow, not total cash flow. For example, we have already, let's suppose, 100,000 cash flow per month. When we accept the project, that will give us 20,000 extra cash flow. So we will consider only this incremental cash flow, not this total cash flow. Not this one. We will consider this incremental cash flow that a result is accepting the project proposal. What should be considered, or what are the principles that should be adhered to in estimating the incremental cash flow? First of all, already incurred cost should be ignored. Sunk cost means that is already incurred cost that have been already invested or already incurred cost. Already incurred cost. It should be ignored because we cannot change this cost. Only opportunity cost should be included in calculating or in estimating the incremental cash flow. We will also consider what this project change in the working capital of the company. We should also consider this working capital increase in our incremental cash flow. Means if we purchase any machine, this machinery will this will result in also extra working capital because we will have to maintain raw material for it, we will have to maintain labor for it, we will have to maintain other things that maintenance, some cash for maintenance of the machinery. So all these things, either it is cash, this new machinery will also result in account receivable as well. So the new machinery and the new project will result in increase in maintenance of cash, account receivable and material. So this increase in working capital will also be included in the project driven changes. But net working capital means that any current asset increase and also increase in current liability, so that increase in current liability due to this project will also be deducted. In inflation, that should not be ignored because we are dealing with those projects who are providing a cash flow for more than one accounting period or one accounting behind one accounting period. So inflations are changing with the time, so we will also include effect of inflation. Tax consideration and depreciation. What is depreciation? Depreciation represents systematic allocation of the cost of capital asset over a period of time for financing, reporting purposes, tax purposes, or both. So systematic allocation of cost of capital asset. Capital asset means those assets whose cash flows are expected beyond 1 year, such as land, structural improvement on land, building, machinery, etc. are capital asset. So these are fixed asset, non-current asset in other words. Over a period of time, when we use this fixed asset or this capital asset for 1 year, we will allocate according to that specific time periods amount into expenses. For financial reporting purposes, it may be we calculate the depreciation for financial reporting purposes such as for income statement. We also calculate these depreciation for tax purposes, or we also calculate it for the both. Generally, profitable firms prefer to use accelerated method for tax reporting purposes. So this method is used in United States for tax purposes. Why it is crucial to teach here? Because most of the exercises in the text are based on this depreciation method. It is no engineering or no rocket science is involved in calculating this accelerated method, but it is specific to the tax purposes in the United States. If there is larger depreciation charges, then we will pay lower tax paid by the firm. Depreciation charges when high, then tax expenses become or goes down if everything remain equal. Depreciation is a non-cash expense. Depreciation is non-cash expense, so that will be added back to the incremental cash flow. Assets are depreciated on one of the 8 different property classes. Makers is basically depends on asset classes. For example, that table will give you that 3-year, this asset falls in 3-year asset class or 5-year asset class. There are different asset classes given in this modified accelerated methods, or 7-year property class. So it will fall in one of the 8 different property classes. There are 8 different property classes. When a company purchases any assets, then the tax department will decide that it is fall in which class, or maybe there is a specific properties who are fall in that property class. So it is easily identifiable that my asset is fall in 3-year or 5-year or 7-year property classes. So there is depreciation. Now, generally, half-year convention is used in makers. Half-year means, for example, this is 1 year, and we buy an asset. This is June. Let's suppose this is January. This is December. This is JUN. This is December. If we purchase any of the assets in July or in August here, then we will charge depreciation for the whole half year. Similarly, if we buy any of the assets here in, let's suppose in March, we will charge depreciation for this half year. So that is called half year convention, not we will not charge for this 3 months, we will not charge for these 3 months, it will be charged for the whole half year. This is one of the modified accelerated cost reductions schedule sample. That is 3-year class. That in first year we will, if any of the asset fall in 3 years of property class, we will charge 33.3% depreciation in first year, 44.45% in second year, 14.81% depreciation in third year, 7.41 depreciation in fourth year. If the asset you buy fall in 5-year property class, we will charge 20% depreciation in first year, 32% in second year, 19.2% in third year, 11.52% in fourth year, 11.5%, 52% in fifth year, then 5.76 in sixth year. If your property falls in 7 years property class, we will charge depreciation according to this schedule. So no method is involved for calculating the depreciation. This schedule will be used to calculate your depreciation. This is all about today lecture. Thank you.